Hi Dreamers, I'm guessing you're looking at your accounts and getting a bit antsy right about now. So I thought you might like to see what my accounts look like on a down day, in a down week, heck, in a down year, just for comparison, and how I'm thinking about all this red and the possibility of more throughout 2023. First, let's take a look at the performance carnage. So I'm recording this about midday on Friday, and you can see today I'm down over $10,000 just in my little account. You can also see that at the beginning of the year it had almost $450,000 in this account, but now is down over $68,000 to just under $378,000. Woof. And that's just my small account. If we take a look at my big account, this one's down over $26,000 just today alone. Ouch. And as compared to the beginning of the year, it's down almost $190,000. Pretty brutal. Now in Fidelity, there's a tab called Performance, and if you click on that tab and go down to the bottom, you can see your year-to-date return as compared to the markets. I've blacked out my account information, and so overall, you can see that I'm down 12.33% as compared to the S&P 500, which is down 16.14%, and the Dow, which is down 17.2%. So actually, in comparison, I'm doing better than the market. So that is one thing you might want to take a look at just to put your losses into perspective. And of course, all of this is happening because we're having to clean up the mess from the pandemic and the resulting supply chain jostling. And essentially, the Fed is having to get inflation under control because if we don't, things could get a lot worse than you can imagine. And so this week, Jerome Powell said, "I wish there was a painless way to do this, but there isn't." And so the Fed is expecting that unemployment will rise from 3.8% this year to 4.4% in 2023, and that it's possible the US could slip into a recession. But the goal of all of this is to actually get inflation under control so that as we go past 2023, we enter into a longer period of sustainable growth. Now, one silver lining to these increases is actually potentially new opportunities for fixed income bonds and CDs. And in Fidelity, you can find that information here under News and Research. And so if you're unfamiliar with this screen, as you scroll down, you can see all of the new bonds, including US Treasuries, what rate they are paying out for 5-year, 3-year, 2-year, etc. All of the corporate AAA, AA, and single A, and taxable municipal. And so if you're looking for some stability in your accounts going forward, although these won't necessarily be an inflation hedge, because they'll stay stable over time, you can now see some interesting percentages starting to pop up with CDs and bonds. And currently, with 5-year CDs being offered for 4.5%. So watch this space over the next few months as we might start to see CDs in the 5% plus range starting to come back. And actually, I think Fidelity has one of the best CD marketplaces where it's really easy to buy and also resell over time. So how am I thinking about all of this going forward, and how will I change my strategy? Well, if you've been following me for a little while, you know that I've been moving into a defensive posture since the end of last year. And that means exiting growth-only stocks that would significantly be hindered by high inflation over the next year. I also have been moving into stocks like electricity stocks, telecoms, consumer staples, consumer defense, because those are things that are difficult for people to turn off. It's much easier to take down consumer discretionary. The other thing as a reminder is that dividends continue to come in and grow no matter what market condition. So they work in down markets, sideways markets, and up markets, no matter what. And so my plan is just to continue to focus on what is on the screen right here, where you can see my actual quarterly dividend income for Q4 2021 at $13,253, which grew to $16,754 in Q1 of 2022, and then again to $18,196 in Q2 of 2022. And at the end of this month, we'll see the results for Q3 2022, which I'm hoping will actually break $20,000 for the first time ever. And this is what I'm relying on for the next year or two, as the market goes up and down and sideways for a while. My growth will come through dividends, and hopefully I'll be able to reinvest some or all in these down markets, so that when we emerge on the other side, maybe in 2024 or 2025, we will be in a completely different situation. So my message to you, dividend investors, is buckle your seatbelt and hang on to the wheel with two hands. Think about driving through 2023 on a pretty bumpy road. But if you can do that, you're going to emerge on the other side with smooth sailing. And I hope all of this helps you put your losses in perspective. Stay calm, stay the course, and carry on. Well, that's it for today. As always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.